Your view on how you'd gauge when this bond market has topped, ultimately in a world where you expect this Fed to start moving in the other direction sometime soon?
Yeah, well, to be honest, the move has been surprising. We got well ahead of the need for the Fed to pivot. But when we hit 3%, I thought we were close to done. So when we hit close to 350, I just didn't think we'd be able to sustain that for as long as we did, frankly, because I thought we'd get a risk off that was even more severe. I think equity markets in particular are very sensitive to the rate market. And if you recall, 2018, we got to about 325, and equities couldn't handle it and frankly forced the Fed into a corner after that December Powell speech where he talked about autopilot. I think we're in a similar situation here, and I think that long end move is relatively done, and the curve's going to get flatter, and it will invert as we continue to risk off, notwithstanding this bear market bounce. And start to see the economy slow into the end of the year.
Is that a constructive view on the long end of the curve or a less constructive view on the front end of the curve? What delivers that flattening?
Yeah, no, great question. Two's surprised us as well relative to how high yields have gotten. But I think 10-year yields will move lower because of the risk-off in equities, which will result in a reflexive flight to quality, while 2-year yields will remain relatively stable because, as I mentioned earlier, we simply don't think the Fed's going to be able to get all the way there before equities risk off and before the economy shows the sort of strains of the tightening that the markets do for the Fed.